$39 trillion. Most people have heard that number. Almost nobody actually understands what it means. It is not a number that appeared overnight. It is not the result of one bad decision or one reckless president. It is the accumulated weight of every war, every crisis, every stimulus package, and every political compromise made since 1789, when the United States was born already carrying $75 million in debt from the Revolutionary War, from 75 million to 39 trillion. That journey took 237 years, and as this map shows, the line only ever goes in one direction. Here is where the story stops being historical and starts being personal. The current gross national debt as of May 2026 stands at $38,910 billion, and it is growing at $85,550 every single second. That is not per minute, not per hour, per second, which means by the time you finish watching this video, the debt will have grown by millions of dollars. Broken down per person, that is $113,792 owed by every man, woman, and child in America. Per taxpayer, the people actually responsible for paying it, that number jumps to $260,000. And look at how the acceleration has changed. It took 192 years from 1789 all the way to October 1981 to reach the first $1 trillion. It took just 5 months to go from 38 to 39 trillion. The debt is not just growing, it is accelerating. Before we go any further, we need to clear up the single most common confusion about this topic. The deficit and the debt are not the same thing. Think of it like a bathtub. The deficit is the tap. Every year, the federal government spends more than it collects in taxes. In fiscal year 2025, that gap was $1.8 trillion, $7 trillion in spending minus $5.2 trillion in revenue. That $1.8 trillion flows out of the tap and into the tub. The debt, the $39 trillion, is everything that has accumulated in that tub since 1789. Every year of deficit spending adds more water. The tub has never been fully drained. And the debt ceiling, that is the adjustable platform above the tub. Congress sets a legal limit on how full the tub can get. When it gets too full, they simply raise the platform. The current statutory cap was raised to $41.1 trillion in July 2025 through what was called the One Big Beautiful Bill Act. The ceiling has never once stopped the water from rising. It has only ever been raised. Now here is the question everyone asks: who do we actually owe this money to? The answer will probably surprise you. The largest single holder of US debt is not China, it is not Japan, it is not any foreign country at all. It is the United States government itself. Nearly 20% of the debt, $7.65 trillion, is intragovernmental debt, money the government borrowed from its own trust funds. The largest of those is the Social Security Trust Fund, which holds $2.3 trillion in treasury bonds. In other words, the government borrowed from your retirement fund and gave it an IOU. The next largest portion, 56% or $22 trillion, is held by the domestic public, American banks, mutual funds, pension funds, the Federal Reserve, and ordinary citizens. And foreign holders, just 24.5%, $9.2 trillion total. And here is the fact that shocks most people about that foreign portion. China, the country politicians most often use to frighten Americans about the debt, holds just $693 billion. That is less than 2% of the total debt. Japan actually holds nearly twice as much as China. So if foreign countries only hold a fraction of the debt, why did they buy it at all? What is in it for them? The answer is something economists call the exorbitant privilege. The United States Treasury market is the deepest, most liquid financial market on Earth. $28 trillion in marketable securities trading hundreds of billions of dollars every single day. Foreign nations buy US debt for 4 fundamental reasons. First, supreme liquidity. When a country needs to move billions of dollars quickly, there is only one market deep enough to absorb it without moving prices: the US Treasury market. Second, universal collateral. US Treasuries are the bedrock of global derivatives markets and repurchase agreements. They are accepted as collateral everywhere on Earth. Third, reserve management. 58% of all global foreign exchange reserves are held in US dollars. Countries that run trade surpluses need somewhere safe to park those dollars. And fourth, exchange rate policy. Countries like China and Japan buy dollars and treasuries specifically to keep their own currencies cheaper, making their exports more competitive. US treasuries are not a burden. They are the world's financial infrastructure. Not all debt is the same. The government borrows money in 3 main ways, and understanding the difference is critical to understanding the risk. Treasury bills, T-bills, are the shortest term, 4 to 52 weeks, $6.62 trillion worth. These are used for short-term cash management and need to be rolled over constantly. Treasury notes, T-notes, are the workhorse. 2 to 10-year terms, $15.93 trillion, more than half of all publicly held marketable debt. These pay interest twice a year. Treasury bonds, T-bonds, are the longest term, 20 to 30 years, $5.37 trillion. These are primarily held by pension funds and insurance companies that need predictable long-term returns. The average maturity across all of this debt is 70 months, about 5.8 years. That number matters enormously, and the next slide explains exactly why. Here is the mechanism that almost nobody talks about when they discuss the national debt, and it may be the most important thing in this entire video. The aggregate national debt has no single due date. There is no moment when America must pay it all back at once. Instead, the debt works like a continuously turning engine. Old debt matures, new debt is issued to replace it, over and over, more than 425 treasury auctions every single year. Right now, approximately 33% of all publicly held debt, roughly $10 trillion, matures within the next 12 months and needs to be refinanced. Here is why that is dangerous. All of that debt that was issued when interest rates were near zero is now being replaced with new debt at much higher rates. The average interest rate on the debt jumped from 1.49% in 2021 to 3.37% by April 2026, more than double. Every time a low interest bond matures and gets replaced by a higher interest bond, the annual interest bill grows. This is how Federal Reserve rate hikes poison the Treasury's finances over time, slowly, mechanically, and inevitably. In fiscal year 2025, the United States paid approximately $971 billion to $1 trillion in net interest on its debt. Let that number settle for a moment. Nearly $1 trillion every year, buying nothing, building nothing, employing nobody, just the cost of carrying debt that already exists. To put that in perspective, the entire US defense budget is approximately $870 billion. For the first time in modern American history, the interest payment on the national debt has surpassed what America spends to defend itself. Medicare costs $865 billion, interest costs more. Education, infrastructure, scientific research, environmental protection. All of those combined do not come close to what America pays just to service its existing debt. And that cracking column in the middle of this slide is not decorative. It represents the moment interest payments broke through every historical budget constraint and kept climbing. $3 billion every single day in interest alone. Here is how the national debt affects you directly. Even if you have never bought a treasury bond in your life, it works like a vice with two jaws squeezing simultaneously. The taxpayer squeeze. 19 cents of every federal revenue dollar in 2025 went purely to pay interest. Not roads, not schools, not hospitals, just interest. Every dollar paying interest is a dollar that cannot do anything else. The private economy squeeze. Every dollar the federal government borrows competes with private borrowers for the same pool of available capital. Economists estimate that every dollar of federal borrowing reduces private investment by approximately 33 cents over the long run, directly slowing business growth and wage increases. And the consumer squeeze. This one hits you every time you try to buy a house. The massive supply of treasury bonds pushing through the market drives up the 10-year treasury yield, and the 30-year fixed mortgage rate is directly tied to that yield, which is exactly why mortgage rates were locked in the 6.5% to 7% band throughout 2025. The national debt is not an abstract number. It is in your mortgage payment, it is in your car loan, it is in your credit card interest rate. So is the debt actually going to crash the economy? Here is the honest answer. Economists genuinely disagree. And this is one of the few topics where presenting all sides fairly actually matters. The fiscal hawks, organizations like the Congressional Budget Office and the Committee for a Responsible Federal Budget, argued that the trajectory is already unsustainable. They point to the debt to GDP ratio and say anything above 100% is critical. Their recommended action is immediate deficit reduction. The mainstream center, the IMF and Treasury, takes a more measured view. They focus on the interest rate versus growth rate relationship. As long as the economy grows faster than interest rates compound, the debt is manageable. Their danger threshold is 120 to 150% of GDP. They recommend gradual fiscal consolidation. And then there is modern monetary theory, the heterodox view that says for a country that prints its own currency, there is no nominal debt limit at all. The only real constraint is inflation. Their recommendation: ignore the nominal debt number and manage inflation through taxation. Three schools of thought, three very different conclusions, all from credentialed economists looking at the same data. America is not the only country with a debt problem, but it may have the most unique combination of risk factors of any major economy on Earth. Japan has a debt to GDP ratio of 230 to 237%. nearly double America's. But Japan survives because its debt is overwhelmingly domestically held. Its central bank owns more than 50% of it, and it runs a current account surplus. Germany sits at a relatively healthy 64%. Italy at 137% is concerning but manageable within the European framework. China officially reports 84 to 96% but hides massive opaque local government debt that makes the true figure significantly higher. And the United States sits at 121 to 124% gross, with a combination of factors no other major economy shares simultaneously. High debt, structural deficits above 5%, demographic strain from an aging population, and meaningful reliance on foreign creditors. The only thing offsetting all of that risk is the one thing America has that no other country possesses: reserve currency status, the dollar as the world's currency. That privilege is powerful, but it is not permanent. Here is something most Americans do not know. The United States has already defaulted, technically, twice. In April and May of 1979, $120 million worth of Treasury bills were delayed due to a processing failure during a debt ceiling standoff. The consequence was a permanent 60 basis point yield penalty that cost American taxpayers $12 billion per year going forward. Then in August 2011, Standard & Poor's downgraded the United States credit rating from AAA to AA+ for the first time in history following the debt ceiling crisis. The S&P 500 fell 6.7% the following Monday. Gold surged 27%. The cost of that single downgrade over the following decade was estimated at $18 billion. In August 2023, Fitch downgraded America's credit rating, and on May 16, 2025, Moody's, the last of the three major rating agencies to maintain a top-tier rating, downgraded the United States as well. For the first time in over a century, the United States of America does not hold a top-tier credit rating from any major rating agency on Earth. Those falling dominoes on this slide are not a metaphor. They already fell. So what actually happens if the United States misses a payment? Not a theoretical collapse, not vague catastrophe. What specifically happens step by step? First, Treasury market dislocation. The moment a payment is missed, the security tied to that payment collapses in price. Cross-default clauses in debt contracts trigger automatically across dozens of connected instruments. Second, money market freeze. More than $6 trillion in money market funds hold T-bills as their primary safe asset. When those T-bills are in question, redemption requests spike simultaneously. The same thing nearly happened in 2008 and the system almost broke. Third, repo and collateral chains. US Treasuries serve as collateral for trillions of dollars in short-term lending globally. When that collateral is suddenly questioned, margin calls cascade across the entire global financial system simultaneously. Fourth, Federal Reserve emergency intervention. The Fed would be forced to step in as buyer of last resort, mirroring what it did in March 2020, essentially printing money to prevent total seizure. And finally, Main Street impact. Social security checks stop, military pay holds, Medicare reimbursements freeze, mortgage rates permanently reset higher. The dollar paradoxically spikes initially as a flight to safety, then begins a slow structural erosion of its reserve currency status. One missed payment, global consequences within hours. Here is the most counterintuitive fact in this entire video. If the United States paid off its entire $39 trillion debt tomorrow, the global financial system would likely collapse. Not because America needs the debt, but because the world does. US Treasuries are the DNA of global financial pricing. Every pension fund on Earth holds them by regulatory mandate. Every central bank uses them as reserves. Every derivatives contract prices itself relative to the Treasury yield curve. If you removed $39 trillion in treasuries from the global financial system overnight, you would eliminate the world's only scale-appropriate safe asset. Pension funds would have nowhere to go. Derivatives markets would lose their pricing benchmark. Global trade financing would cease. We know this is not theoretical because it almost happened before. In the late 1990s, the Clinton-era surpluses were so large that economists projected the entire publicly held debt could be retired by 2012. The Federal Reserve held emergency meetings trying to figure out how to run monetary policy without treasuries. The problem was never solved. The surpluses ended on their own after 2001. And the one time in history a president actually paid off the debt. Andrew Jackson in January 1835. The resulting financial instability triggered the Panic of 1837 and a multi-year depression. The debt is not just America's problem, it is the world's infrastructure. So where does this all end? According to the Congressional Budget Office projection, if nothing structurally changes, publicly held debt reaches 172% of GDP by 2054. Every American under the age of 18 is already carrying approximately $500,000 in gross debt as their inheritance. In the mid-2030s, the Social Security OASI Trust Fund, the one that holds $2.3 trillion in treasury bonds, is projected to be depleted. At that point, automatic benefit cuts of approximately 23% would be triggered unless Congress acts, and the compounding interest costs are mathematically crowding out every future investment in research, infrastructure, and education that the next generation will need to compete in the global economy. Three forces converging simultaneously: an expanding debt baseline, depleting entitlement to trust funds, and compounding interest blocking the investments that create the growth needed to escape the cycle. This is not a Republican problem or a Democratic problem, it is a math problem, and math does not care about politics. The question is not whether this is serious. The data on every slide in this video answers that question clearly. The real question is whether the people responsible for solving it have the will to do so before the cost of waiting becomes larger than the cost of acting.